Good morning, everyone. Thank you for joining us for today's weekly morning call. Today, we have a number of stock counter updates, a technical analysis on some counters, and for the macro and sector outlook, we have the FOMC meeting highlights that was on last week and Singapore Weekly. So without further ado, let me hand over the presentation to Jonathan.
Thanks, Darren, and good morning, everyone. So for me, I'll be covering Spotify's third quarter results, titled Volume and Price Growth. So overall, for the third quarter of this year, Spotify's revenue beat expectations modestly, and earnings missed due to higher than expected expenses. The key highlights were total MAU, which is monthly active user, and premium subscribers beat guidance, up 20% and 13% respectively, showing resilience through quite an uncertain macro environment. Gross margins of 24.7% missed guidance marginally by 0.5%. On the positives, outperformance in volume and price growth drove third quarter revenue to beat expectations marginally. In terms of premium subscribers, this number grew 13% to 195 million. So they actually beat guidance by 1 million, with premium ARPU, which is prices, average revenue per user, increasing also about 7% year on year. So both these kind of growths led to a 22% year-on-year increase in premium revenue for the third quarter of 22. Just for some context, premium revenue makes up about slightly over 90% of total revenue for Spotify. The second positive is that total MAU, monthly active user growth, is actually re-accelerating. So Spotify had about 456 million total MAUs at the end of the third quarter of 2022, beating guidance by 6 million. So this represents to about a 20% year-on-year growth, or about 5% quarter-on-quarter. So a lot of this MAU growth or MAU re-acceleration was actually attributed to strength across the Latin American and rest of the world regions, mainly because of successful marketing campaigns. On the negatives, gross margin missed guidance by 0.5%. There were actually three main reasons for this. The first was an accrual adjustment due to the renewal of its publishing contracts. The second was the overall macroeconomic slowdown. And the third was FX headwinds affecting cost of revenue. In terms of gross margin, premium gross margin was 28%, which was down 1% year on year, with ad-supported gross margin at 1.8%, down 9% year on year. Mainly due to slower than expected ad revenue growth and increasing non-music content spend. The second negative is that Spotify is actually seeing rising expenses or higher than expected expenses, which is actually leading to widening net losses, at least for the quarter. So operating expenses for the third quarter grew 65% year on year. This was mainly led by higher headcount growth due to expansion, higher advertising costs, and a 14% negative FX movement. Spotify ended the third quarter with net loss of 166 million euros, with year-to-date net loss of 160 million euros. Next slide, please. In terms of outlook, 2022 continues to be a year of investments for Spotify. So it continues to invest quite heavily in its improving its platform, as well as non-music content investments like podcasts and audiobooks. Spotify also guided the fourth quarter revenue to be about 3.2 billion euros, representing about a 19% year-on-year growth rate. In terms of total MAU and premium subscriber growth, Spotify guided this to be in an 18% and 12% year-on-year growth rate. So they expect total MAUs to hit 479 million and premium subscribers to hit 202 million. The guidance for gross margins for the fourth quarter is expected to be 24.5%. So we maintain a buy, but we lower our FY 22 PATMI forecast by 500 million euros on the back of slightly higher expenses. We maintain a buy with a reduced DCF target price of $111, with a WACC of 7.5% and a growth rate of 3%. So that's all for Spotify. I'll pass my time on to Ambrish for Airbnb. Thank you.
Thank you, John, and good morning, everyone. So today I will be covering about Airbnb's third quarter results. We had released the report last week with the title Record Earnings as Travel Demand Persists. Next slide, please. So Airbnb, it is basically an online marketplace for your homestays and unique experiences. And overall, the results, they beat expectations. In terms of its performance, for the 9-month 2022 revenue and PATMI, they came at about 79% and 115% of our full year 2022 forecasts. Total revenue in the third quarter, it grew by about 29% year on year to $2.9 billion, and this was mainly because of strong travel demand. Meanwhile, PATMI, it jumped by about 46% year on year due to higher operating leverage. Moving on to the positives. First of all, strong travel demand continued in the third quarter. So it's the gross bookings value, which represents the dollar value of bookings on its platform. It rose by about 31% year on year to $15.6 billion. And this was mainly because of a surge in both volumes as well as price. So the number of nights and experiences booked were 99.7 million in the third quarter, and it grew by about 25% year on year. The company cited that the growth mainly came from urban and cross-border travel as the COVID restrictions, they were eased. Secondly, the demand for long-term stays, they remained resilient. The stays of over 28 days, it accounted for 20% of its volume. It was stable year over year. Meanwhile, stays of at least 7 nights, they accounted for 45% of its bookings volume. And this was mainly because of flexibility due to the remote work. Lastly, active listings on its platform, they surged by about 15% year on year. And it grew back from 10% growth rate in the previous quarter. We think that it mainly because of the company's new initiatives to attract hosts, and it includes Ask a Super Host. So moving on to the negative, there was one negative. The average daily rates, the company cited that it could decline in the fourth quarter and as well as into 2023, and mainly because of a business mix shift towards the urban destinations, as they have lower rates due to small accommodation sizes. This could impact margins. However, management, it suggested that it could be offset by higher operating leverage. So moving on to the outlook. Next slide, please. The travel demand is likely to continue in the fourth quarter, and the company expects its revenue to grow about by 17 to 23% year on year. And the revenue is expected to be in the range of $1.80 billion to $1.88 billion. And adjusted EBITDA is expected to remain stable at about 22%. We estimate that its gross bookings value to grow by 20% year on year to 13.5 billion, and the bookings volume to grow by about 24% year on year to 91 million. In terms of its valuations, we increased full year 2022 revenue and PATMI by 1% and 26%. The significant surge in PATMI was mainly due to lower expenses. And as a result, our DCF target price increased to $128 from the previous $119. Overall, due to the pressure on consumer spending due to macro uncertainties like rising inflation and interest rates, we still believe that Airbnb is positioned to benefit from flexibility in remote work as well as a rising demand for alternative accommodations. So that's all for Airbnb. I would now like to pass on to Max to cover Apple.
Thanks, Ambrish. So we also published a report on Apple for its fourth quarter 2022 results with the title of Proving Its Resilience. Next slide, please. Yeah. So Apple's results were in line with our expectations, with revenue and PATMI at 100% of our full year 2022 forecast. The company recorded $19.1 billion in revenue, which is 8% growth year on year, and PATMI came in at $20.7 billion. For the positives, firstly, Apple's hardware revenue remained resilient. Its iPhone revenue grew 10%, while its Mac revenue grew 25% year on year. And this is despite the negative industry sentiment that says the demand for PC and smartphone is going to decline. Apple attributed the strong Mac performance due to the backorder sales of its M2 MacBook Air that suffered from supply constraints in the third quarter of 2022. This means that when Apple launched the M2 MacBook Air in the third quarter, it didn't have enough supply to satisfy all the demand from the customers. But fortunately, the customers were patient enough to make their purchases, and they decided to buy the products when it becomes available, when Apple has stabilized its supply chain. Both the iPhone and Mac actually set a new record for quarterly upgraders, with the iPhone growing switches by double digits. And during the fourth quarter itself, around half of the Mac buyers were new to the product, suggesting that Apple was still able to attract and capture the attention of new customers. For the second positive, Apple experienced growth in its international markets despite the strengthening of the US dollars. Aside from Japan, revenue across all geographies outside of the US experienced growth, with Europe growing 10%, while the rest of Asia Pacific region grew 23% year-on-year. And this is despite the fact that Apple faced headwinds during the conversion of local currencies to the US dollars. Apple also credited the strong performance in several large emerging markets, such as India, that set revenue record, while other countries like Thailand, Vietnam, Indonesia, and Mexico grew double-digit during the quarter. However, for the negatives, we have one, and that is Apple expects revenue growth to decelerate during the first quarter of financial year 2023. Apple expects revenue growth to be lower than the 8% that it enjoyed during the fourth quarter of 2022. And this is mainly because of the 10% of expected FX headwinds. Furthermore, Mac sales is also expected to decline substantially year-on-year, and this is because of the tough comparison against the first quarter of 2022, where it benefited from the launch of the newly redesigned M1 MacBook Pro. And during that quarter itself, Mac sales actually grew 25%. Lastly, Apple expects services to continue its growth, but will be hindered by macroeconomic environment that increases FX headwinds and decreases spendings on digital advertising and games on its app stores. However, we would like to point out that Apple has indicated that its digital advertising business is not large when compared to its other businesses. As for the outlook, the management guided for the first quarter of 2023 gross margin to be between 42.5% to 43.5%, and this is slightly above the 42.3% that it recorded in the fourth quarter of 2022. This is despite the increasing expected FX headwinds, as the management believes that the favorable movements in the commodities market can offset the downside. Furthermore, Apple also reaffirms its confidence in services, viewing that the effects of foreign exchange on the segment is to be temporary, and that the segment also has strong fundamentals to support its future growth. This includes the continued growth in device installed base, as well as the increasing engagement of users onto services such as evidenced by the paid accounts and transacting accounts growing double digits, while the paid subscription increased by 155 million during the last 12 months alone to 900 million, which is double the amount that it recorded 3 years ago. Lastly, during the call, Apple also indicated that its iPhone 14 Pro, 14 Pro Max, and Apple Watch Ultra continue to be supply constrained. This suggests that the higher-end models of the iPhones and the Apple Watch are selling better and are in higher demand, which will definitely benefit Apple in terms of the increased average selling price. So for our valuation, we take into account the benefits of the increased ASP that contributes towards the revenue growth, but we also took into account by the fact that the volume growth is likely to be challenged because of the lower demand compared to FY22, and the continued lockdowns in China is likely to pose significant uncertainties on Apple's supply chain, such as the latest instance of the lockdown in Zhongzheng, where the main factory of Foxconn actually operates, that caused Apple to announce this morning that they are expecting challenges for iPhone shipments during the quarter. All in all, We maintain our buy rating with Apple with a target price of $190 using DCF with a WACC assumption of 6.4% and terminal growth rate of 3%. With that, I'll hand over my time to Glenn to cover DBS. Thank you.
Thanks, Max. So for DBS and their recent third quarter 22 results, the earnings of 2.24 billion were in line with our estimates, and this was mainly due to higher net interest income and net interest margins, which was slightly offset by lower fee income and higher allowances. The 9-month 22 PATMI is at 77% of our FY22 forecast. The third quarter DPS is up 9% year-on-year at 36 cents. So some key highlights: the net interest income surged 44% year-on-year to 3 billion on NIM expansion of 47 basis points to 1.9% and loans growth of 6% year-on-year. The fee income, however, fell 13% year-on-year due to weaker market sentiment, while other non-interest income increased 32% year-on-year. The third quarter ROE increased 4.2% year-on-year to 16.3%. So moving on to the positives, the first positive was that the NIM and net interest income surged. Net interest income grew 44% to 3.02 billion due to a NIM increase of 47 basis points year-on-year to 1.9%. So for some comparisons, the first quarter, the quarter-on-quarter growth for the first quarter was 3 basis points. The second quarter was 12 basis points, and this quarter it was 32 basis points. And as well as continued loans growth of 6% year-on-year. The loans growth was driven by housing and non-trade corporate loans, offset by lower trade loans as the maturing exposures were not replaced due to unattractive pricing. Management has maintained their NIM guidance excuse me, of 1.75% for FY22 and targets to reach 2% by the fourth quarter. The second positive was that the other non-interest income was up 32% year-on-year and quarter-on-quarter, mainly due to higher treasury markets non-interest income, treasury customer income, and investment gains. The last positive was that their asset quality is stable and their third quarter allowances was at 178 million. So while the third quarter allowances were higher year-on-year and quarter-on-quarter due to higher general provisions of 153 million for the quarter, the credit cost nonetheless improved by 4 basis points year-on-year to 2 basis points, as specific provisions were lower year-on-year and quarter-on-quarter to 25 million. The GP reserves rose to 3.9 billion, with NPA reserves at 120% and unsecured NPA reserves at 216%. The NPL ratio also declined to 1.2% from 1.5% a year ago, as new NPA formation remained low and was more than offset by higher upgrades and repayments. For the negatives, the first negative was that the fee income declined 13% year-on-year, and this was mainly due to weaker market sentiment affecting the wealth management and investment banking, which was more than offset by increases in card and loan-related fees. The wealth management fees fell 30% to 323 million as market conditions further weakened during the quarter. Investment banking fees also fell 38% to 25 million alongside a slowdown in capital market activities. Nonetheless, the card fees showed improvement of 24% to 223 million, as borders start to reopen and spending increased, while loan-related fees increased 15%. The second negative was that the current account and savings accounts ratio, or CASA ratio, fell 8.9% year-on-year to 60.3%, and this was mainly due to the high interest rate environment and a move towards fixed deposits. Nonetheless, total customer deposits increased 9% year-on-year to 533 billion. The management has said that the drop in CASA was expected and that the increase in the fixed deposits was actually higher than the drop in CASA, hence a net increase in deposits. For the outlook, DBS's business momentum is strong, and despite the economic uncertainties from macroeconomic factors such as slower growth, higher inflation, and supply chain disruptions, their loans and transaction pipelines are expected to be strong. The management has also mentioned that the stress tests of vulnerable sectors and countries reveal no imminent areas of concern. Their GP reserves are also sufficient, and with its capital position and liquidity well above the regulatory requirements and high allowance reserves, we believe that DBS has sufficient provisions to ride out the current economic uncertainties. So while their CET1 ratio dipped 0.4% quarter-on-quarter to 13.8%, it is still at the upper end of DBS's target operating range. Lastly, the management has said they expects to end 2022 with an exit NIM of 2%, and DBS has also reiterated that a 1 basis point rise in interest rates could raise their net interest income by 18 to 20 million. As such, we maintain our buy recommendation with an unchanged target price of $41.60, and we raise our FY22 earnings by 3% as we increase the net interest income estimates. We also raise our FY23 earnings by 6% as we increase the net interest income estimates. Our ROE estimate for FY23 has also been raised from 14.7% to 14.9%. So moving on to OCBC. So OCBC is quite a similar story as DBS. So their third quarter earnings of 1.61 billion were in line with our estimates, and it came from higher net interest margin and net interest income, which was offset by lower fee income. The 9-month 22 PATMI is at 73% of our FY22 forecast. For key highlights, the net interest income grew 44%, underpinned by loans growth of 6% year-on-year and NIM surging 54 basis points to 2.06%. The total non-interest income, however, dipped 4% year-on-year as lower fee income was partly offset by higher trading and insurance income. The allowances also fell 6% year-on-year to 154 million. For the positives, the net interest income grew 44%, led by loans growth of 6% and NIM improvement of 54 basis points to 2.06%. The loans growth was driven by Singapore, Indonesia, and Greater China, while lending growth was broad-based to the building and construction sector, financial institutions, investment and holding companies, as well as the consumer segment. The NIM expansion was mainly due to asset yields outpacing higher funding costs amid a rapidly rising interest rate environment. OCBC has guided for a similar mid-single-digit loans growth, but increased their NIM guidance to 1.8 to 1.9%, and this was from 1.7% for full year 22. For the second positive, their insurance and trading income increased, and life insurance profit from Great Eastern Holdings rose 21% year-on-year, mostly due to the net mark-to-market impact of higher interest rates on the valuation of assets and liabilities in its insurance funds. The trading income also increased 134% year-on-year and largely comprised of customer flow treasury income. The third positive was that their total allowances fell 6% year-on-year to 154 million, and general provisions of 76 million and specific provisions of 78 million were made during the quarter. Total NPAs were also down 7% quarter-on-quarter and 13% year-on-year to 3.69 billion, and the NPL ratio improved by 10 basis points quarter-on-quarter to 1.2%. However, there was an increase in the Greater China NPLs by 18% Q-on-Q, and this was mainly due to one Singapore-based customer on a property investment. Nonetheless, OCBC has mentioned that it's a customer with low LTV and the risk is specific to that particular asset. So their credit costs improved by 7 basis points year-on-year to 14 basis points due to the better credit environment. For the negatives, the first negative was that the fee income declined 20% year-on-year to 453 million. And this was mainly due to a drop in the wealth management fees as customer activities were subdued and risk-off investment sentiments globally. The decline was also partly offset by growth in other fee segments, including credit card and loan and trade-related fees. The second negative was that their CASA ratio fell by 5.9% year-on-year to 56.1%. And this was mainly due to the high interest rate environment and a move towards the fixed deposits. Nonetheless, their total customer deposits increased 6% year-on-year to 353 billion, mainly due to the growth in fixed deposits. The group's funding composition remains stable, with customer deposits comprising about 80% of their total funding. For the outlook, their loans grew 6% in third quarter, and this is meeting the bank's guidance of a mid-single-digit increase for full year 22. However, the management has said that it expects continued economic growth, but at a slower pace due to the current economic environment. They also see further lending opportunities in the wholesale segment and sustainable financing. For China, OCBC's total exposure to mainland China remains stable at 11%, with the onshore exposure at 7 billion and offshore exposure at 27 billion. Nonetheless, their customers include mainly top state-owned enterprises, large local corporates, as well as OCBC's network customers. The onshore China corporate real estate loans make up about less than 1% of their total loans. So the value is about net less than 3 billion Sing dollars. And this is mainly lending to their network customers. For their NIMs, the management has raised their NIM guidance to 1.8 to 1.9% for full year 22, and it expects their fourth quarter NIM to be above 2.1%. They've also said that based on historical data, 100 basis points increase in rates will lead to an 18 basis points increase in NIMs. As such, we maintain our buy recommendation with an unchanged target price of $14.22. We raised our FY22 earnings by 6% as we increase the net interest income and lower provision estimates for FY22. We have also raised the FY23 earnings by 13% as we increase the net interest income estimates. Our ROE for FY23 is also raised from 11.2% to 12.5%. The catalysts for OCBC include lower provisions and higher net interest income as the economic conditions improve. OCBC is also our preferred pick among the three banks due to their attractive valuations, upside in dividends from the 14.4% CET1 buffer, and lower provisioning as the Indonesian and Malaysian economies recover. So that's all I have for the banks. I'll now hand it over to Darren.
Thanks, Glenn. So CapitaLand Ascott Trust announced their third quarter business update. So just some highlights is that their third quarter business gross profit is at 90% of pre-COVID levels. So that's the only thing that they mentioned. And other than that, they did mention some RevPAR numbers. So it's a positive for the third quarter 22 RevPAR as it grew 88% year-on-year and 6% quarter-on-quarter, and it's at 87% of pre-pandemic levels. So the year-on-year improvement was driven by both higher ADR and higher occupancy. So as you can see from the top left-hand corner, this is the breakdown of the portfolio RevPAR. So Australia, Singapore, UK, and US all came in over 100% of year-on-year growth. Singapore was boosted by mainly the F1 in the third quarter. So for China, it's still quite flat, and for Japan, it's negative slightly because of the high base in during the Olympic Games last year. And we see Japan as one of the key points to grow, a key catalyst, because after the reopening and then because of the weak yen and its popularity as a tourist destination, we believe that the RevPAR numbers will start to grow or start to shoot up going forward. Another positive is that the standard stay segment remains resilient, which comprises of about 15% of the third quarter 2022 gross profit. The occupancy of the longer stay properties remains stable at more than 95%, and for the student accommodation, 99% is leased for the academic year 2022 to 2023 with above market rent growth of 6%. The other two graphs that you see here, one of it is the portfolio RevPAR growth. On the bottom left, we can see that it is still creeping up slowly, and it might hit pre-COVID levels by next year, which is 160, the portfolio RevPAR. And then this one is the quarter-on-quarter RevPAR. Quarter-on-quarter, I mean the RevPAR for every quarter, and then the quarter-on-quarter growth and the year-on-year growth, as well as the portfolio occupancy. Another reason why we like Ascott and the positives is that they have a high proportion of debt at fixed rate, 76%, which is locked in for 3.5 years. And they managed to secure a low borrowing cost, or rather they maintained their low borrowing cost at 1.7% this quarter after repaying and financing the majority of debt due. So the remaining debt due in 2022 is only the Chinese renminbi debts. So this is, we think this is impressive, because in this rising interest rate environment, if we can maintain a borrowing cost, it means it's impressive. So every 50 basis point increase in interest rates would have a 2% impact to DPU. So for the negative, Ascott was quite affected by the Sing dollar appreciation. So the impact of FX after hedges in place on gross profit was 2.1% for the 9-month 22. A 5% depreciation in foreign currency implies about a 3% impact to DPU. So Ascott, they do hedge their income that they receive from foreign currencies, but then they do not disclose how many percent they hedge, but they did mention that it's increasing. So for the outlook, electricity cost has increased definitely, and however, it still remains less than 10% of OPEX. Most of Ascott's electricity requirements have been hedged through fixed rates contracts, which last for about 1 or 2 years, and they are usually passed through to tenants in the longer stay assets such as student accommodation and Japan rental housing properties. While there is a there's a usage cap for service residences, so anything above the cap, you have to pay. Yeah, so with that, we upgrade Ascott to a buy with a lower target price of 1.13 from 1.24, as we lower our FY23 to FY25 DPU by 5 to 7% on the back of foreign currency headwinds. Our cost of equity also increased from 8.14 to 8.35 on the back of a higher interest rate assumption, highest risk-free rate assumption, sorry. And some of the catalysts include the reopening of China, opportunistic divestments at a premium, and any acquisitions of extended stay assets to raise the proportion of their stable income sources to their target 25 to 30% to cushion the impact of recessionary concerns, rising inflation, and macroeconomic uncertainties. So right now, the proportion of this segment is about 19%, 90% after the acquisition that they announced, 300 million announced in the previous quarter. So with that, I will hand over the presentation to Terence to talk about First Sponsor.
Thanks, Darren, and good morning, everyone. First Sponsor reported third quarter voluntary results that saw its Dongguan projects have faster sales. So in terms of the positives, Time Zone saw faster sales in the third quarter of 2022 versus the entire first half of 2022. So the residential sales of its 17.3% owned Human development saw sales accelerate in the third quarter of 2022. It saw 306 units move versus 329 units move for the whole of first half 2022. In terms of its European property holding segment, it also saw a stronger performance for both its office and hotel portfolio. Operating results at 77% of FY22 were in line. It was also this hotel portfolio was also driven by stronger RevPAR, which is driven by both better occupancy and also better rates charged at its hotels. In terms of its property financing business, lower tax liabilities also saw a higher recovery of the group's renminbi 330 million PRC defaulted loans. So if you look at the table here on your left-hand side, you can see that for First Sponsor, they had under the PRC property financing business, they had two loans that essentially went bad. The first is the Putong Villa, valued at renminbi 50 million, and the second is the Putong Mall, which is 280 million renminbi. The total of these two, Putong Villa and Putong Mall, formed $330 million. 330 million renminbi rather in total defaulted loans. So the key is in the book exposure to borrowers, which is the last row. You can see that the net effect of the recovery is that the overall book exposure that First Sponsor have is now reduced to renminbi 80.9 million from the initial 112.8 million renminbi. So they managed to recover more from their defaulted loans. And this 80.9 million renminbi is solely from Putong Mall, which is this second column here. And Putong Villa, they've completely recovered the total outstanding amount already. So it's now Putong Mall, and they're still trying to pursue legal action for this 80.9 million, and over time they expect to fully recover the current defaulted loan. We'll provide an update when they do. In our next slide, in terms of the negatives, Another of its major residential project, Primus Bay, which is at Panyu, Guangzhou, continue to see slower sales. For the third quarter of 2022, only 2%, they only saw an incremental 2% of units sold, which is bringing the total number sold to 13% from 11%. The reason why is because the residential the real estate restriction policies are still in place in Guangzhou versus in Dongguan. So in terms of outlook, the outlook for First Sponsor is positive because they have 2 new property projects in Dongguan that is set for launch in FY23. These 2 new property projects were won in that they won for Dongguan was won just in the third quarter of 2022. And given the more relaxed property restriction measures in Dongguan, we expect the property projects to actually perform well for financial year 23. The group will also continue to explore, capitalize on their strong balance sheet on new opportunities, especially in the Greater Bay Area. With that, we maintain our accumulate rating on First Sponsor with an unchanged sum of the parts target price of $1.39. So that's all from me for First Sponsor. I'll now hand over the time to Zane.
Thanks, Terence. Good morning, everyone. I'll now go through the technical analysis section. So for Straits Times Index, following the bounce last week, we confirmed the wave 3 lows for in this 5-wave downtrend pattern. So last week we went in the wave 4, we reached a high of around 3,133, which is a 50% retracement level. So for this week, the immediate resistance we could see, if the index continues to climb higher, we could see it go to near the 3,172 points, which is a 61.8% level, and also it meets a swing high back in early October. So the resistance will continue to lie at 3,070 to 3,170, while the immediate support could be at 2,970 to 3,040, which is the wave 3 lows area. Next slide. As for the S&P 500, after we reached about 3,900 last week, we broke down an immediate short-term uptrend channel after the FOMC meeting. So this week, we continue to see resistance at the 3,008 to 3,900 level, where 3,008 is an important horizontal level that we have actually crossed up and down a few times. As for immediate support-wise, probably it will be at the range from 3,005 to 3,650, which is the swing low in October, mid-October, as well as 3,650 will be the swing low created in mid-October as well. So we'll, if we pull back to the support zone, we'll probably move in a range pattern for now. Next slide. For individual stocks, we have 2 of them. The first one will be Fraser Logistics and Commercial Trust. So for this, we have a technical buy at $1.13, the TP at $1.25, stop loss at $1.09, and the stop loss closed at $1.09 last Friday. So this stock, it actually hit our stop loss, so the trade was invalidated. We saw there was a potential corrective wave to retest the resistance at 120 to 128 in the current downtrend. Because the price actually broke out of a downtrend channel resistance back on 28 October, after it found support at $1.04 to $1.09, confirmed with a double bottom of $1.07 swing low made in late October 2020. Also, the MACD indicator was displaying signs of momentum, where it sustained a fresh bullish crossover for 2 days. With that, the price could reach the resistance at 125, which is confirmed with a 50% Fibonacci retracement level. And from an Elliott wave perspective, the stock completed a 5-wave downtrend formation, and we could see a ABC correction waveform to retest the resistance zone back then. Next slide. So the other stock will be Geo Energy Resources. For this, we have a technical buy at 40.5 cents, the TP at 49.5 cents. Stop loss can be placed at 38.5 cents. The stock last closed at 40.5 cents on Friday. For this, there was a potential breakout of a bullish cup and handle formation to retest the resistance zone at 46 cents to 50 cents area. The price has been finding support at the 20-day moving average recently while making higher lows, and it closed at the handle of a potential cup and handle formation with increasing volume on the 2nd of November, which signals that buyers have been in control since the previous volume surge back in 25th October, and this provides us with a bullish signal. Also, the MACD indicator continues to display bullish momentum in the recent consolidation phase near the handle. With that, the price could reach the resistance level at 49.5 cents when we use the height of the cup, which is 9 cents, projected against the current price, 40.5 cents. And this will give us a target around 49.5 cents, which is confluent with the high made in 19 April this year. So that's all from me from my section. I'll pass on my time to Sean to talk about the FOMC highlights.
Yep, thanks, Zane. So I'll be going through the meeting's highlight that happened on the 2nd of November last Wednesday. So for those who may have missed out on the FOMC last week, the Federal Reserve has raised the federal fund rate by another 75 basis points, which makes it the 4th consecutive 3/4 percentage hike this year, bringing the current rate to a range of 3.75% to 4%. And in this November's meeting, there's no dot plot graph being provided, as it is published every quarterly, so the next one will be available in the December's meeting. So despite slower growth in the consumer spending, inflation still remains well above the rate of 2%, as total PCE prices rose by 6.2% over the 12-month ending in September, and excluding the volatility of food and energy category, core PCE prices rose by 5.1% year-on-year in September as well. This data led the Fed to point out that price pressure remains evident across a broad range of goods and services, and with the ongoing Russia war against Ukraine, it has also boosted prices for energy and food, which have created additional upward pressure on inflation. In terms of guidance, Chairman Powell did not mention any clear indication in this meeting. However, he has pointed out that there could be a possibility of a slowdown either in the December's meeting or the following one in Jan next year. But no decision has been made as of the current moment, and it will be dependent on the totality of the incoming data. And currently, the market is split between either a 50 basis point or 75 basis point increase in the December's meeting. CPI results will be released on this Thursday, so with the release, it may give us a rough indication on the potential hike in the next meeting. Some notable sentences that were mentioned by Chairman Powell in this meeting were the questions to when to moderate the pace of increase is now much less important than the question of how high to raise rates and how long to keep monetary policy restricted. And it is very premature to think about pausing, signals that the Fed still remains firm on their tightening course, and also suggesting that the ultimate level of interest rate might be higher than their previous expectation. So that's all I have for the FOMC meeting. And with that, I'd like to hand over the time to Paul to discuss about Venture Corp.
Yeah, thanks, Sean. Next slide. So Venture released their 3rd quarter update on Friday. Just as a reminder, because it's an update, so there isn't much financial details. They just give you a snapshot of some of the financials. Nevertheless, the results is within our expectations. But you can see from the table on the left, the earnings was very strong. It jumped about 27%. So part of it, if you recall, there was a lockdown in Malaysia a year ago. So of course, when you compare to this year, they will get that improvement. The company also said that there was growth across all sectors. And also what we think is also the strong US dollar has probably also helped the earnings, because most of the revenue is in US dollar, and probably their cost, maybe half of it comes from ringgit. It's ringgit-based cost because most of their plants are in Malaysia. So the positives, again, talking about ventures, so they don't really give much details, but they just said that the growth was across all verticals, all sectors. The revenue that you see here, the 1 billion, you're back to the 2017 where they achieved the record earnings. So this is the 2nd highest quarterly revenue. The negative, which is also the similar negatives that we faced in the 2nd quarter results, was the inventory is elevated. So to cope with the the supply shortage, which they did say that it is improving, and also of course with the strong demand, they actually increased their inventory to almost 1.25 billion. Of course, it's something to be noteworthy. I mean, something to also monitor. I mean, hopefully there isn't any obsolescence and so forth, but no, so far there hasn't been any indication. The other thing is just that they also had higher effective tax, so this is a big drag to earnings. So you can see from the table, the PBT was supposed to jump 35%, but then because of the higher effective tax, so you could say that took up like 8 percentage points of margins. So just quite a big drag because of the higher effective tax. Otherwise, the earnings could have been at least 35%. So in terms of the outlook, they don't really give much details, but they just said that they are expanding capacity in Malaysia to cater to the demand. For us, at least, we think the trend towards outsourcing or more production away from China, especially with all the recent lockdowns to Southeast Asia, continues. But we're just a bit cautious of the macro uncertainty, and not just for them. I mean, just a broad macro concern. So that's why we didn't move the numbers and so forth. Sorry, ignore the previous. So the earnings remains the same, unchanged at $20.80. We leave our revenue, but just kept our margins unchanged. Okay, next slide. So for NetLink released their first half results. So for NetLink is always very stable, but this quarter you will notice the EBITDA there was a big 15% jump. That was mainly because a year ago they had some remeasurement loss of some of the central office equipment. So that's why it looks like a big growth. But if you normalize it, it's about 5% jump in EBITDA. So the earnings was within expectations. The positive is there was a bounce in diversion, but diversion is just the margins is lower. The divergence is just that whenever there's a new track and so forth, they need to install new or move the cables a bit, then they will get this diversion revenue. The negative is just that the interest jumped 42%, although the effective interest is still low at 1.9. And one thing good was that they did manage to hedge out amazingly 510 million, which is like, because their total loans is about 660. So bulk of their loans, they managed to hedge out until 2026. So you don't have to the jump in interest rates won't be so drastic because they hedge out most of it at almost 1%. So for the outlook, it's basically two things. I think firstly is the cash flow will be stable, but the other thing is the regulatory review, which they said will only be announced in the first half. So regulatory review, as a reminder, is where the authorities will relook at all the fiber, because all of us are charged fiber, because it's a monopoly. So the authorities will review whether they should maintain or lower the prices. We think there could be a slight reduction. Again, this is like a lot of guesswork here, but mainly because the number of customers increase and so forth. But for us, I think the underlying investment thesis is just that we don't find it attractive to get into this stock because there's limited growth, which in the past was a good investment thesis because of the yield of 5%. But right now, when you have limited DPU growth, it's going to be challenging. Especially if you think that interest rates are going to reach 5%, which is what the futures curve, then a 6% dividend yield isn't very attractive, which they are paying now. In the past, the dividend yield spread, that means the spread between the 10-year bond and what they pay was about 3%. So maybe the government bonds was 1.5 and they typically pay 5%. So there was at least a decent spread. Right now it's dropped to 2.4. And this may not be enough because interest rates are going to go up maybe another 100 basis point, 1% or 1.5%. That means you're virtually not getting much of a spread. You're not getting extra yield pickup when you buy this. So especially if you're not growing your revenues. So that's why for us, they're cautious and then we downgraded our target price. But in part, we downgraded the target price also because we raised our interest rate assumptions. Next slide. So move on to a weekly next slide. So in terms of the macro numbers that came off of Singapore, manufacturing activity is still slowing down. I think we saw it last week when we talked about industrial production, and we see it again here in the PMI. So PMI is the Purchasing Manager Index. It's a survey of on all the manufacturers, like how are they doing. So what they're saying is that it is 49.7. So this is the lowest reading in 29 months, and this is the 6 months of continuous weakness. But Singapore economy itself, the domestic is strong. So we see in the retail sales, excluding the volatile motor vehicles, the MV, retail sales Singapore is extremely robust. It's like up 17%. We at this supermarket, but it doesn't really matter now because seeing some results out, but just for reference. In terms of the US, of course, we had the Powell. So just as a refresh, as in what is at least some of the rationale why he's raising rates. So as to why he's raising rates, because to him, the labor market is extremely tight. So he says that the demand supply is out of balance. So the labor market is so strong, so he can raise rates. And then he worries, this is always the worry for all central banks. Even MAS mentioned this, that they always worry of inflation expectations. So they worry that if everyone thinks inflation is going to keep on rising, then it becomes like a vicious cycle. Then workers will ask for more pay. Then in the end, the inflation goes up a bit, and then get this spiraling effect. And then by how much? So all he said was that the rates will be higher than what was the September expectation. So September, I think the median rate was about 4.8. So and then he wants a real interest rate. So we think he could stop at maybe around 5%, which the curve is suggesting at March. For how long will he raise rates? That one's a bit hard to say, because all he said was just premature to pause now. And whether he wants to cut rates, I think is again even probably all he said is that he's worried of what happened in the past where they cut and then the inflation spiraled up. But I guess the one that market took comfort was that he does know that you keep on raising rates, right? You will impact the economy with a lag. The other news that came out in the US was the payrolls, which is again one of the weakest increase in number of workers in 23 months. So all signs are that the slowing down continues in the US and of course globally. The other interesting tidbit, I mean, we don't cover UK, but it just stuck up that they raised interest rates and they said that UK will have a recession in next year and also 2024. But again, one of the assumption here is that they said that this is based on what the market thinks is the interest rates. So if the market thinks that there's a 5.25% interest rate by next year, so he thinks if interest rate reach these levels, now UK will have 2 years of recession, starting from the second half of this year. So in terms of tactical view, there's going to be a theme of almost peak Fed, basically a peak in interest rate hikes, and also maybe that will also together with the peak US dollar. So what we think is that there will be another 125 basis points increase in rate hikes till maybe 5% in March. So this is not the end. There's still going to be more, but then maybe we could see the positioning into REITs. But do note that we still think there's weakness in REITs, because if interest rates are 5%, then usually there's like a 2% spread before you buy a REIT. I mean, roughly, any REIT you buy, you might have to ask for at least 7% minimum dividend yield before you think about it. Because otherwise, if I can buy anything at 5%, why would I want to buy a REIT at 6%? So that is the direction interest rates are heading. Of course, whether they will cut it is a different thing, but at least currently, 5% is now the new risk-free rate now, I guess. But I think, so in terms of the events to look about next week will be, of course, the US midterms. The main one will be the US CPI. So just the expectations is about 7% increase. So the market is expecting it to decelerate from, I think, 8.1. So people still think the inflation rate will come off a bit. But if it goes above this number, above the 8, I think then the market might sell down one more time, because then you think that the Fed might have to tighten even more. Then interest rate expectation will jump up again. These are some of the events, like Elite, iRead, and so forth. If you have time, we also have Zoom. Not doing the Zoom thing. This is the Zoom company itself. Yeah. Next slide. This is just an illustration. You can see that things are slowing down in Singapore, at least for especially electronics. And globally, it's also slowing down. You can see it also is the lowest rate in 29 months, almost 2.5 years for services and manufacturing. Next slide. Okay, so this is the table on the left is just the interest rate where the market thinks. So in the box, the 4.4 you see here, sorry if it's a bit small, it is December 50 basis points. Then roughly another 50 basis points in February. Then in March, sorry, not Feb 23, in March 23, you're talking about another 25. Then we will hit 5% interest rates. So this is where the market thinks interest rates will peak by March 23. The table on the right is, I think, just an illustration of payrolls. Next slide. So just a few more ones for me. Phillip on the ground, just we had the Nanofilm briefing. So there was a lot of financials. They just gave an update. So the only financials update they gave was the 9 months revenue grew at 10%. But because in the first half, revenue grew 15%. So what it means is that roughly maybe the third quarter was single digit growth. So why they said about the slowdown is because of the COVID restrictions. There's a lot of restrictions, and of course, the other thing is the Apple thing. So Foxconn Zhengzhou is the biggest, is a big site for Apple, and one of Nano's customers is is Apple. So the other thing is just for Nanofilm, they got two parts of the business. One is coating, and that means people supply them maybe some parts, and then they will coat it. And then another business they do is equipment. So they also say that the equipment business is facing a downturn now because customers are cutting capex. So that one is purely macro, they said. Yeah. So the outlook, I think, fourth quarter we think is going to be soft for them. It's going to be another weak quarter for them because the coating services is going to be dragged down by customer Z, which is actually Apple, and also the decline in the equipment sales, which I think only started in third quarter. So you should normally when the weakness starts, there's usually at least a few quarters of weakness. The table on the right here is their chart. I'm sorry, a bit confusing here. So what they say is that the revenue would be from 247. They think the revenue can double by 2025. But 2025 is so long, right? Anyway, it's their forecast, and their gross profit. It is pet me actually, so they think they can hit 100 million of profit by 2025. Again, 2025 is so long, but anyway, this is their numbers. This is what they're telling the market. Next slide. Okay, this is our model portfolio. So we were down 2.4. So we were down compared to the market, down 1.2. So we were 1 percentage points weaker than the market, mainly because of my poorly timed SGX inclusion. I'm not sure why it dropped so much, 11%, but it was one of the big drags. But do know that why we added SGX is because number one is to hedge against volatility. We just worried that the market might have a huge weakness. So we just wanted it because if volatility spiked, it will benefit SGX, and also SGX is the beneficiary of rising interest rates. I mean, even more details you can ask Glenn, but basically, all the clearing members have to park money with them. So they also have their equivalent of a CASA in a way, which they earn interest on. So what did well was banks did well outperform against. Next slide. So in terms of the overall market, what has done well in the table on the left is the REITs continue to be weak. So REITs was still down across different sectors. The table on the left, then shipping did well because of Yang Zhejiang, and also Sembcorp Marine. On the right, you can see this a snapshot. The big gainers was, I'm not sure why MedTech, but this is one of the gainers. But probably the COVID thing together with UG Healthcare. But the losers was very clear as all the tech names like UMS, AEM, Nanofilm all got sold down. Valuetronics all got the weakness. Below is just some of the STI winners and gainers, again, just for your reference. So Yang Zhejiang did very well. UOB also did well. And all the banks, the losers were here, like CLI. Next slide. So this one, as usual, we just give you an update, like what asset classes did well in US dollar terms. So the US market, of course, did very well, the S&P. One of the worst ones was REITs. So you can see for the year, REITs are down 22% in US dollar terms. Asia ex Japan also down, but I think with rumors of China reopening, it probably might have bounced back up. Next slide. Okay, this is just again, we always just flash for everyone's reference in here. Of course, this you can use this as a tourist. You want to go where you want to travel chart also can use. But anyway, this is Singapore currency against. So actually, Singapore strengthened against the US dollar, and we were actually very strong against all the Southeast Asian currencies. I think the MAS tightening policy probably was quite evident this month because we tightened. We were stronger than our trading peers like China, Malaysia, Indonesia. But again, this is the one that that appreciated was actually GBP, which is the British pound. Again, this is just for reference. Next slide. Okay, next slide. Okay, I think we can move on to questions here. Thanks, everyone.
Thanks, Paul. So I think I'll take the. Oh wait, sorry. Let me change my.
You can go to the community channel.
Give me a minute. Sorry. Okay. Yeah. So I'll take the banking question first. This one. Let me find it. Yeah. Okay. So of the three local banks, which saw the greatest and the least impact from the China lockdowns? So I think if you want to look at the greatest impact, if you see which bank is concentrating on China, so that would be OCBC. I think they have said quite a few times that they are looking to continue to expand into China. However, they have taken, of course, a slower approach now. And if you look at their loans, so their loans by geography, I think the OCBC has the largest one, which is about 76 billion, and then compared to UOB is like 50 something, and DBS is about below 40, I think. Yeah, so OCBC would have the greatest impact from the China lockdowns. As for the least impact, I think the other two banks are quite similar. Yeah. Okay, I think that's all. I'll hand it over to the rest of my colleagues.
Yeah, I'll take the next few questions. Please comment on ST Engineering going forward. Any impact from US dollar? And where is US dollar going next year? Yeah, so I think there are three questions here. Let's take the first one. The ST Engineering comment on ST Engineering going forward. So for ST Engineering, the order books are strong. They have about $21 billion in order book, which is a high compared to the average order book that they have over the last like 6-7 years. When you look at the average last 5-6 years, it's just always around 15 to 16 B. So they are 21 billion now. So we expect the order books to support their revenue going forward. And they also reported uptick in their business segments for the defense segment and their aerospace business. Both are trending well. The defense is seeing a very strong uplift. The aerospace is recovering. So the overall trajectory for ST Engineering is positive. Any impact from, second question is any impact from US dollar? Yeah, so for ST Engineering, you cannot see them as they are net long beneficiary of US dollar in general. Their business is net long USD. So when US dollar go up, that's generally good for their business, all things equal. And where is US dollar going next year? So I got no idea in terms of the trajectory of US dollar. But if I were just to hazard a guess, then like what the most of my teammates mentioned, the stronger the continued hike of the US Fed rate should support the US dollar in terms of its current levels. Paul Terrence, Sembcorp Marine, with latest development, it is now acquiring KOM instead of the merger deal previously reported by some analysts as a disadvantage to Sem Marine. But guess Sem Marine will still issue rights going forward. Does it make sense for existing Sem Marine shareholders to participate in the likely upcoming rights issue or exit when its price is trending up now? Thanks. Yeah, so they haven't announced the rights issue, so it's a bit premature to try to comment on this rights issue. Whether they decide to do a rights issue or not at this moment is still uncertain. But what we'll say is that the new revised agreement between Sem Marine and Capital O&M is positive for shareholders. I think like what you rightly pointed out, the price is now trending upwards post announcement, and that's because they will be acquiring KOM at a lower price. That means a lower share issuance. And then the last thing is that the combined entity will also be much stronger because of the order book. The order book will be lifted up to $18 billion when the two entities come together. So Keppel O&M will have $11 billion in order book brought in, and Sam Marine's $7 billion combined to have $18 billion. So the new entity will be much stronger. So I'm not sure if you want to. I think it's a little bit speculative if you want to go and sell and then you want to buy back later or things like that. When there are a couple of parts that is unknown at this moment. This question is also for Paul. So I don't know if Paul has anything to add. Paul, do you want to add anything?
Yeah, I think it's okay. Yeah, nothing much.
Oh, okay. then let's go to the next question. With higher rates, we might see higher Singapore mortgage rates. Any thoughts on Singapore residential properties? More upside still, or we range here? Yeah, I'm on your first point. Higher rates would naturally lead to higher Singapore mortgage rates. In terms of the Singapore residential market, we continue to be bullish on the Singapore residential market because we haven't seen any stress in terms of how the mortgage higher mortgage rates have depressed property demand. In fact, property demand continues to remain robust. For most of the new launches this year that was launched by some of the developers like Lentor Modern or Piccadilly Grand, those in general saw prices that were above $2,000 per square feet. It means record prices, and also were generally 75%. So I think the property developers themselves remain bullish on the property market. I think they're just a bit more cautious in terms of acquiring land, but they still remain bullish because of the strong pent-up demand for residential property. I think that's all for me. I'll pay back the time to the rest of my team.
Now, let's take a couple of the REIT questions. So there's one on Maple Tree Peninsula Commercial Trust. Yeah, first of all, for that we do have coverage, but then the comment is that it seems to be languishing since the merger. The last time was $1.57. Your views, please. So then again, I'm not sure whether this is mainly because of the merger or because of the general REIT macro sentiment. Like just now Paul mentioned that the Fed Fund futures, if it hits 5%, maybe first quarter next year, then what's the point of buying a REIT which pays also about 5% dividends? Might as well just buy some risk-free T-bill or something that pays close to that. So we don't see this there is much value in buying a REIT because of the use spread. Yeah, so that is my view for that. And I think there's one on Suntec REIT also. I think the first part I'll let Paul answer. The USD movement going forward, which stock are impacted by USD moves. I think that one quite a lot, but please comment on Suntec REIT and its dividends in the future. So for Suntec REIT, they are quite impacted by the interest rate rising because their hedge ratio is only about 50+%. So if that kind of hedge ratio, you have to pay way more for your interest expense, and then that will definitely affect your dividends that you receive in the future also. And then on top of that, their interest coverage ratio is also not very high. Is if I'm not wrong, below 3. So because MAS has this 2.5 times interest coverage ratio. So if you cross the threshold, then you can bring your gearing to over 50%. If you are under that, then your gearing will maintain at 45%. So most REITs will definitely want to have their ICR above 2.5%. So that also backs Suntec REIT. So I'm not sure whether Paul has anything to add for that. Yeah, so I think that's all for me for now.
Yeah, thanks. Yeah, no, yeah. Sorry, I was just trying to. Oops, sorry for that. No, I was just trying to answer this data pulse question. So I was looking at. Please advise data pulse rights warrant issue whether to take out the rights. Yeah, this one very hard to compute, but My guess is just to take it up because why I say it's hard because so what is happening is that data pulse is 10 cents roughly. Then they have a rights issue for warrants to take out at 1 cent, and the conversion of the warrants is 9 cents. So yeah, theoretically, it may or may not have any impact because it's almost priced like a rights issue 1-for-1 at the same price. So they kind of, I wouldn't say disguise, the way they did it was quite interesting. So the theoretical X-rights price, that means after the rights issue, the share price won't drop much. I think it will still stay the same. So I don't think it's a very clear answer whether to pick up the rest because there isn't really much of course, unless you go more sophisticated, you want to look at the volatility and so forth. So I'm a bit hesitant. I'm a bit neutral whether to take up the rights warrants because although you might pay 1 cent for it, but if you to subscribe to the share is 9 cents and the current share price is about 10 cents, so there could be a marginal benefit to subscribe to it. So I'm a bit neutral to it whether to take it up. That's why I'm a bit hesitant. But the caveat is just that the 1 cent warrant, it's in the money, and then there is a value to having the warrants. So because it's an option, right? So there's a value to the optionality. Yeah. So sorry, I'm just a bit neutral whether to take it up, but yeah. Because you won't immediately lose out, but there is the option value which is very hard for us to calculate because there's probably a 0.5 cents option value because of the current share price now, but then you're not sure once the rights issue come out whether people convert and then the shares. So sorry, I don't really have a good answer for you. It's a bit of a neutral to slightly positive to take up the rights. Of course, I'm not sure what the business is doing. It was an interesting way to raise money. They do a rights then, so not to press the share price down immediately, because if they do too dilutive, the thing can come off. Yeah. How about, do you expect any impact from ongoing COP27 in our region? Okay, the one of the impact which I can think of course, the point we can't really quantify. Of course, there's a carbon tax, which will be probably going to be imposed at companies like Capital, which I'm not sure what's the impact financially. Then you can ask Terence, but there is one thing, there's a carbon tax. The second thing is the company that will benefit it is, like I think we highlighted before with Marco Polo Marine, because a lot of companies like China and Taiwan building offshore wind will benefit them because they just bought a very huge vessel that is specifically used for offshore wind. I forgot the name of the vessel, but they are one of the beneficiaries of it, because they're preparing themselves for a huge offshore wind installation coming out from Taiwan, and curiously also China. So and Korea, sorry, Taiwan and Japan, sorry, not China, Japan and Taiwan, sorry, which can use their vessels, because this is a vessel that can help carry those big wind turbines, and there are very few, according to them, in the industry right now. Let me do a few before I hand it to Zane. Hi Paul, any thoughts on the Comfort Delgro in light of the win in Australia? Think we are about the lows. Any technical views? Okay, so Zane will do the technical views. So I look at the announcement. They don't give details, right? So of the 3 contracts they won, the bus contracts, I think 2 is an existing one. We have for us to comment, is it incrementally positive, because they never tell us, and all this a lot of confidentiality. The third contract that they won, so it's a 1.5 billion contract. If you split it up, I'm just doing mathematics here, and then just assuming each is 500, and this one the new one is a 500 contract over 7 years. So you do it maybe 570 million a year. Won't really move the needle, because for their public transport business is almost like a 2 billion revenue. I mean, totally, it's Comfort's about 3 billion. So 70 million won't really move the needle for Comfort, but again, it is a positive, but I don't think it's a very significant positive. Again, there's no briefing on this. They don't give us details, and they will never view, because it's always confidential, but I don't think it's that material. It is good to have, but I don't think based on this mathematics. Yeah. Update on Nanofilm. Yeah, I think I give an update. Yeah. So unless you all mention if it's a TA update, then we will put TA. Yeah. Sorry for that. Yeah. What caused Hong Kong market to rally last week there was a WeChat circulation saying, yeah, it's all about the reopening of COVID. But one of the interesting things that one of the CEOs mentioned, which we did mention before, is that eventually China has to open. I mean, China needs economic growth to sustain, I guess, the people there. So it's just a matter of time when they will open the restrictions. Of course, the timing no one knows, but they cannot keep on doing this. So the guess some people say could be March. I'm as good as anyone in terms of guessing. They're not very. I'm just reading off the press, but just as to sustain the country, the people, you need economic growth. So it's just a matter of time. Yeah, this is not much value at there. But, Paul, your views on Olam in the next 6 months, given your sharing on good commodity. Yeah, the problem we have is whenever we ask Olam, the commodity price rise, does it help them? They are not very direct, not very clear an answer, because they are doing more processing and outsourcing. So it's a benefit, but it's not very clear like a plantation company. Yeah, so they are benefit more if the volume increase. Yeah, so that's why we will ask many times, but we can never really get higher prices may not. For instance, like they are doing cashew now, I'm just giving an example, doesn't mean the higher price, the profit, the higher price benefits the planter, but they are more into processing and also transportation, logistics, and so forth. So that's why it's not very clear that they will benefit. Indirectly to a little bit, but I don't think it's not clear. The planters benefit most of it, the farmers and so forth. Yeah. So for them, again, if the equity markets improve, the IPO market improve, then the whole restructuring thing will happen. They will do the listing in UK, but don't think it's going to happen this year for sure. Hi, Paul, interest rates stay high beside banks. What other counters or sectors will benefit? The two notable ones I think that we mentioned before is the banks, of course, and also the SGX. So SGX is the other one. I know nobody asked me this, but because we got asked before, but earlier in the morning. So let me just try to explain again. Maybe Glenn already did. I wasn't listening, but how the banks benefit. So just as a reminder, that most of you already know, but so why the banks can do well is because most of their loans, 90% or 70 to 90 is variable. So when interest rates, let's say, rise 2%, they immediately call all the customer, oh, your interest rate already up. So then the thing is the deposits that they pay, like half a deposit is CASA, so they don't actually have to increase because that's free money. So then they have to increase will be when they get more fixed deposits. So that's why the surge in margin is going to be huge for at least the next 2 to 3 months, because they will call all their customers and raise interest rates 2%, but the cost of the deposits is going to move very slow, and some of them, because they are CASA, right, you won't even increase also, because current account, savings account, they hardly pay us, and even if they pay is maybe 10 basis points, 20 basis points more, but they just charge the customer 200 basis points more. I mean, yeah. So it's only the FD repricing they get affected. So even though margins will climb until middle of next year, even if it drop, it might just taper a little, it won't like collapse. So the key thing for us is always the amount of CASA they have. Yeah. Okay, yeah, I know nobody asked me that, but yeah. Can give an update on Yoma. Really nothing much. They're just going to be announcing the results of this. And for us, the problem is politics. I think so long as the political situation doesn't improve, what it translates is that there's no foreign direct investments into the country. And then without foreign direct investments, the country can't grow. It doesn't mean you go and collapse anything, but it's just that there isn't any real growth driver for the country. There's no foreign investments. But separately, what we see is that Southeast Asia is doing very well. There's a lot of investments. Maybe I'll pull up the chart next time, but Southeast Asia investments, especially like in Malaysia, there's a lot of Chinese investments coming in. There's like they're setting up huge recycling paper. There's huge steel factories coming up in China, and assuming China reopens, like you highlighted for the first country they will go is Southeast Asia, because this is probably the friendliest country. The only country they want to trade with them is Southeast Asia. So I think in general, Southeast Asia for foreign investments, be it a lot of it coming out from China, but it's not only multinationals, it's also, we think, the Chinese domestic companies coming out of China. The first place they want to do business is, of course, Southeast Asia, because since we are much friendlier than the rest. With the recent rise in Hong Kong equities, do you believe President Xi is finally softening his stance? Yeah, sorry. I think we can only guess. I'm not an expert in China, but yeah. Sorry, can't really give. What we do is what we okay, the US dollar moving cover. Which stocks are impacted? Actually, the electronic companies are the ones that benefit from stronger US dollar because most of our Singapore listed companies, their factories, like you look at UMS or EM, they're either in Singapore or Malaysia. Those that are in Singapore, in China already like not doing well, like Valuetronics. And that also, so actually the electronic companies benefit, but there are other things to worry about. So currency is one factor, but if the demand suddenly tail off, that's the other factor. So one of the things that on Friday, I was also in a call with Westports. Again, we don't cover ports, but it's a good, because ports, you can get a gauge of activity, like trade activity. So what they did say was that in the second half of September, they saw a sharp decline in demand for containers. So that's my worry, is that the weakness that you see in growth is only happening in September onwards. The other thing is congestion in ports are improving in the region because there's less COVID. So in the past, what happened was that when the port in Sri Lanka closed down, all the containers were stuck. So the supply chain is improving. That's a positive. But now that there's a huge demand weakness out of Europe, and it only started in September or second half of September. What's your views at SIA? I probably keep on saying the same thing. So we're not very favorable with SIA because of competition from the top and bottom, from low-cost carriers and Middle Eastern, and also the fuel price. So that's why we never really covered. Yeah. Technical, I think I had handed to Zane. Okay, I think we did most of it. Yeah, I think we pass it to you, Zane. Then we try to get back to some of the questions. Yeah.
Okay, let me just share my screen now. Okay, so I'll just start off chronological order. First one I see is Golden Agri. So Golden Agri has been in this continue to remain in nice uptrend. Last week we broke out of the key resistance at 28 cents to 29 cents region, and then we hit a high of around 30.5 cents. So that's about when using the swing high and the swing low over here, that's about 61.8% resistance level. So we hit a short-term resistance here for now. Let's see whether the short-term support can change to 28.5 cents, which was a resistance over here. But if we go further down, we might come back to test this channel support line over here. That's about the old support around 26.5 cents to 27 cents area over here. And the next one is the three banks. So for DBS, we broke out of this the trend channel over here, as well as the resistance zone over here. So for now, if you go higher, the next resistance could be at around $35 over here, which was a swing high. Currently, the resistance is last week was formed around 34.80 over here. So if we come back to retest this previous resistance turn support, then we could see some sideways trading for now. Yeah. And next one is OCBC. And OCBC, last week we broke out of this green color zone over here. Previous resistance now could be a support zone. Then the immediate resistance now is at this red color zone. That's about remains at around 1220 to 1240 region. Or the support could be at around 1180 to $12 region for now. Then UOB is the strongest. So after the results, it shot up to clear the previous resistance here around $27.50 to $28, this green color zone. So that could become a support zone for now. If it continues to go higher, we could see reach the $29 mark, which was a swing high back over here in May this year. And then using the Fibonacci is 61.8% level. So that's a level to look out for. Okay, then the next one is SAM Industries. So SAM Industry broke out of this downtrend channel over here. Immediate resistance wise, probably we could see a retest of the 50 to 61.8% level. That's close to 314 to about 323. So this red color zone over here. Then for immediate support wise, probably this resistance zone that we managed to climb back into. So that's around $2.90 to $3 for now. And Samudera Shipping, we broke out of, we are still in this downtrend channel over here, but after I think there was a profit update, profit guidance around that, then we broke out of this downtrend line over here. But we are still stuck in this, we are still resisted by this recent swing high back then, around 90 cents level, this red color, first red color zone over here. But if you continue, if you do breakout, we could see it go to the 50% to 61.8% level. That's close to 95 cents to 99 cents area, which also meets with this channel resistance over here. Then if it drops back down, we could see it retest the support around 79 cents to 82 cents level over here. Then Golden Energy was forming a wedge pattern over here. We broke out over here following that time, I think the news. Currently looks like probably try trading in a sideways direction for now. So the support is around 86 cents level over here, while the resistance we could see a retest of the 92 cents to 94.5 cents region over here. So that's for Golden Energy. And Hang Seng Tech and Ping An. Okay, so for Ping An, following the rally in the China and Hong Kong, looks like the support is around here, around 32.30 over here. The next resistance it could hit up to is around 37.50, close to 37.50 and 39.50. So that's when we look at the weekly time frame. It was a 37.50 was a level here last time, and then 39.50 is another horizontal level above it. So that's the next two levels to watch out for. Okay, then Hang Seng Tech. So this one looks like we are doing a retest of this previous support term resistance at $3.44 over here. So but if we do hit higher, we could, the next one is the retest of this swing high over here around 364 region over here. Then if we hit higher, it could go to around near 390, which is another swing low over here, and then the 50% retracement level. So that's for Hang Seng Tech. Okay, moving back to Singapore market. Okay, Yang Zhejiang, still in an uptrend for now, but looks like the volatility has been shrinking. Has been in this rising wedge for now. So the room is over here. For now, the immediate support around, I think, probably around 123, 124 over here, while the resistance is around 128, 130 region over here. But if we get out of the wedge over here, and we could retest this long-term trendline resistance, that could bring us to around 137 around here. Yeah, so that's Yang Zhejiang. Then CLI rebounded after the results. So the short-term the support is around close to around $3 over here. Then so we're going to some resistance over here. That's around around from 320 to around close to 328. That's the 50% retracement level. So short term wise, we could see some resistance over here. But if it does continue to climb higher, we could go back to around 335 to 345 region, which is another resistance zone previously. So these two red zones to look out for. Okay, China aviation. Okay, for this, after you hit the double bottom over here around 66 cents, recently rebounded a little bit. So currently the resistance for now is around 70 cents to 75 cents over here. Then while the support is likely to range from 64 cents to around 66, 67 cents over here. Okay, Geo Energy, which I covered as now. Looks like today we broke out of this cup and handle formation. So you're looking about if you're looking at short-term resistance, will be this swing high over here around 42 cents to 43 cents region, which also meets with the 61.8% level. So this 415 to 435 is a short-term resistance zone, but if we overcome it, then we can go back to the year high made around here near the 50-cent mark. Then the short-term support, as you can see, the higher lows made around here, probably 40 cents to 40.5 cents would be a very strong support for now. Okay, sets after the sell down made the stock retest swing low of the back in March 2020. So the support was formed at around near the 250 region to the 260, close to 265 mark. Then the short-term resistance one probably will be this consolidation zone after the gap down over here. So that we're looking at about 295 to 315 over here. That will be a short-term resistance for sets. Okay, for Neo, it looks like it's a rebound to test this previous support turn resistance zone for now. So the level we're looking at is it could hit around 100 to around 118 over here, the short term. But if it goes a bit higher, it tests the 123 level, the 50% retracement level. Then the short term support, the lowest one is at around 71, 72 base was formed here. Then we broke out of this immediate resistance over here around 88 over here. That could become a support for now if it forms a higher dose to do a short-term rebound. Okay. Okay, Alibaba looks like also similar, doing a short-term rebound to test the previous support and resistance area. So the first one was this low around $71. Currently we are around there. If you go higher, it could go to near the $80 mark, which is another swing low back over here that was broken over here. So that's the levels to note. Yeah. Then short-term support wise, probably this level which we broken out from that's around $67. Resistance here they're broken out of, and then we opened low over here, but we went higher. So this is a short-term support for now. The next one, JD also, all the charts looks pretty similar. So we broke below this 156 swing low, and then we recovered back. So short-term the next resistance could be near 190, which was this previous swing low region over here, to 210, which is this swing high over here. So it matches with the 50% to 61.8% retracement level from here. Then short-term support-wise, probably this green color zone, that's around 158 to 170. This resistance zone that we managed to break out of. Okay, and I think I'll just go through one more before I hand back time to my colleagues. Uncovered just now. Okay, I'll go through the AEM and venture. Okay, AEM, after the sell down, looks like we formed an ascending triangle over here. We managed to break out of the immediate resistance at around 336 over here. So that could become a short-term support for AEM. The bounce, some levels we can look at if it continues to bounce higher is probably around the 360 mark, which is a 50% retracement level, and near the 370 mark, the 61.8% retracement levels. Yeah, so that's for AEM. And as for venture, so this red color zone, the previous support level zone that we broke down of, we managed to recover back after the update. So the next level we could look at is probably $17 if it continues to go higher, which is this swing high over here, and a 50% retracement mark. If it continues to go higher, we could see close to 1740, which is the 61.8% retracement level. And then it's around here, so that would be around here. So that would be a retest of this channel support that we broke down off. So then immediate short-term immediate support-wise will be around close to 1630, this resistance level that we broke out of over here. So that's all from me for now. I'll hand back my time to my colleagues.
Thanks, Zain. So I think I'll take one question regarding the iFast. The iFast has been moving last week, but why? So I think you asked the questions because their net revenue is down, and I think the net profit is also down this quarter, but that's year-on-year basis. So if you look at quarter-on-quarter basis, they recovered from last quarter's net loss due to the impairment charge for the restructuring of their India business. And I think there's two main reasons why it's moving. It went up. It's because firstly, their Hong Kong e-pension, so they expect it to be kicking in earlier, and it's expected, at least from their last guidance, it expected to add profits of more than 17 million in 2023, more than 44 million in 2024, and more than 88 million in 2025. And this is all Sing dollars. So this will benefit them quite greatly. And the second reason is also because they are expanding into their bank, so their digital bank in UK. So they have also incurred the initial startup losses, but they plan to achieve profitability starting 2024. So I think people are looking at more of the long-term play for iFast because these two contributors are quite big to their bottom line. So just to reiterate, we don't cover iFast. I don't think there's anything else for me. I'll hand it over to the rest of my colleagues. Thanks.
Darren, can you take some of the read questions, then I'll try and close it. Thanks.
Yeah, so land lease or CICT. So which do you prefer? So for this, I'll just look at the interest rate hedging, because that is, I feel that's one of the most important factors now for REITs. So for land lease now, there are about 60% hedge versus CICT, which is about 80%. So definitely the CICT is less impacted by the rising interest rates, especially if it hits 5%. I mean, there will be a huge impact. So for that, definitely prefer CICT over land lease. And then may I have your assessment on Keppel REIT? So for Keppel REIT, actually, they just announced last 2 weeks ago their acquisition of this Japanese property. So I find this a bit questionable, this acquisition, because first of all, they don't have it's their first foray into Japan, and then I mean right now acquisitions are only probably possible in Japan because of the low interest rate environments. All the cap rates are maintaining rather flat. But then this property is only 36% pre-leased. So I think they have some problems trying to fill up the occupancy there. So yeah, so regarding this acquisition, I think it's rather questionable for me. Yeah, and then of course for Keppel REIT, the same old things that are impacting them, like the interest rates and such. So yeah, I'm not too bullish on Keppel REIT for now. Let me see any other questions. Yeah, I think that's all. Yeah, hand it back to my teammates.
Yeah, okay, thanks. Let's try to what are your top Hong Kong picks? Yeah, I think for Hong Kong stocks, you have to ask our Hong Kong colleagues, because we don't really cover Hong Kong. So yeah, sorry for that. Yeah, we don't cover. We only cover mainly Singapore and US. Likewise, no, please comment on China market. Yeah, so, yeah, don't really can provide that. Hi, last week update, it was mentioned industrials and financials are leading stock indexes. Can you suggest stocks that are in the category, as your focus has been on tech? I'm not sure, Jonathan, do you have anything on what are like industrial names? Yeah. Assuming interest rates remain high in 2023 and there's a recession, which sectors do you favor? Yeah, so for us, it's just the handover part. So right now, our own view for what is worth. I mean, we are still underweight REITs, but we think that handover after there is there could be a sell down. Then one more round of selling. I think that's what we think, because the rate hikes hasn't been finished, or although it's coming near. Then we think that handover will be to the REIT sector. So I think our view is just to look at REITs in the first quarter. That will be the sector to look at. Then any of the domestic names, but from this one you are touching on very small cap names, because if you're talking about retailers or F&B companies, these are the ones that are doing well. But again, these are very small mid cap names, which may or may not kind of interest everyone. We also like those marine stocks, like we mentioned Marco Polo, so forth. I think that is where one of the big tailwinds is happening now. There's a big capital spend again coming, not as big as the last time when the oil prices were high, but there's a big bounce in capital spending for at least the marine sector. So these are some of the sectors that we find there's better earnings momentum. Yeah. High going forward, can venture and AEM sustain their high profitability quarter and quarter? For venture, they definitely can do it of quarter on quarter because fourth quarter is seasonally better. Likewise for AEM quarter on quarter. So I think fourth quarter, because AEM already guided very strong revenue for this year. So I think for next quarter, it is still fine. It's just the subsequent quarter, which I think that's where the market might be a bit more nervous. But if you're taking a very short-term range, or if you're banking on fourth quarter earnings, I think it'll be very strong. Yeah. Because seasonally, that is typically the strongest for them. The ones that hit the worst now is all the consumer electronics centric, I know, like the PCs and handphones, which I think venture and don't touch it because venture is more industrial and AEM is more equipment, so that's why they will be a bit more sheltered. Is AEM a buy and what target do you have? What about Intel as the customer? Yeah, so the key thing for okay, we don't cover, but AEM is, I think, is more technical like what Zane said. But in terms of Intel as the customer, that is going to be the strength, because I think Intel still has the roadmap to roll out the wafer fabs. And the key thing for the AEM is to transition out into a new memory customer, which they said they have done so. But I think with the memory market this way, I'm not sure whether the memory customer is going to raise any capex this year. So Intel is a good customer because the wafer fab, you're looking at least another 2 years of wafer fab construction. Then they install the equipment. So I think there's still visibility for them at least the next 1 year plus. Because that's the equipment. That's not like end customer products, so that will still do well for them. Yeah, because and because in the US wafer fab these days is more strategic. Not so much whether demand supply is whether it's in equilibrium. So they might, like I said, there's going to be an overbuilding of wafer fabs, and that will be the what will benefit AEM ironically. Okay, what caused the gap down in stats? I'm not sure, Terence. Yeah. Let me answer this last one. What's your view on QMN Dental's earnings going forward? I think the earnings will be weak because last year they had the COVID-19 earnings, and COVID-19 testing testing earnings. So this third quarter will be year-on-year will be down because they don't have that. And they also have an additional expense item, which is because they're developing an AI software. So with this software, if you go into any Q&M dental clinics, this software will give a recommendation, because every dentist these days, if you go, every dentist has their own view of what should be the proper treatment. So those that are strong in removing teeth, I'm just giving an example, will always say, I think you should remove your teeth. I'm just giving an example, I'm not saying that it is, but with this software, it will give a more independent view of what should be the proper treatment, or the independent view of the treatment that the patient should get. So they're still building this software, and it's going to cost, it's going to pull some of the earnings down, because that is one of the additional R&D expense that they're going to face. But assuming this works, this software, software, they can sell it anywhere, not only in Singapore, even in China or whatsoever, and then maybe charge $1 or $2 for whoever uses software per user. But again, this is a 3 to 4 year kind of roadmap. But near term, they have to face up with this kind of expense, this R&D expense, to build up this software, which is good longer term, but near term it might be a drag on earnings. Terence, you want to go on the sets thing?
Paul, maybe I can take the one on the industrials and financials. Yeah, so just to add on to Paul's response on some of the suggested stocks for industrials and financials. In terms of industrials in the US, I think you can look at UPS, John Deere, Caterpillar, and even, I guess, Boeing and 3M. So 3M actually had their earnings out towards the end of last month. They have pretty solid earnings. So you kind of saw a big ramp up in their stock price for that. In terms of financials, we don't cover them, but generally, I think we try to focus more on the retail banks, so like Bank of America, Wells Fargo, because the one that's really dragging down the banks are the losses from, or not losses, but I guess the underperformance in investment banking. So a lot of your big private banks, that investment banking arm has been dragging it down. Whereas when you look at more retail banks, like Bank of America, Wells Fargo, they've been doing a bit more, they've shown a little bit more resilience in that sense. Yeah. I think that's all for me. Thank you.
Yeah. Okay. And let me just take a shot at SATS. So for SATS, the overhang is they still need to raise money. So they might have to raise, I think 1.7 billion. They probably might have to raise another 800 million of equity. So that's going to be an overhang because there's the unknown when they're going to announce this, and usually there's going to be dilution. What it means, not the dilution share price, but the theoretical X rights price. That means if you don't take up these rights, the share price, how much is it going to drop? So that's a better measurement of the impact of the rights issue. So I think there's a bit of an overhang. Yeah. So like we joked before, if you put $1 now into SATS, you better get ready for another 30 cents because if you don't take up the rights, you're going to get diluted. So I think that's going to be the overhang. And secondly, we think the earnings may not be that strong in the near term. I think the earnings should be coming up in 2 or 3 days' time. But I think what they mentioned is that they are investing ahead because they know that the airlines are coming back in, so they cannot wait until got 10 flights, then I hire 10 people. Man, that's not the ratio, but they probably have to hire like 40, 50 people before before the flights come in. So they're going to get a bit of a overhang in terms of the cost. So we think very near term, there will be downward pressure on SATS. And then of course, after all these things are resolved, then the share price can bounce back up. But that's why we think these are the two big overhangs. The earnings won't be good near term because of the cost and also the need to raise money. Last one, Sean, you want to do this treasury bill? Yeah. For those who want to subscribe to it. Yeah, just for anyone who wants to, I guess any basic thing. Thanks, Sean.
Sure. So can I ask about treasury bills? So regarding treasury bills, the last one that was released was back in, I think, 27 October, which closed off at 4.19%. The one currently that is open, it's on 3rd November, which is last week, and will be closing on 10th November. So I believe that this treasury bills rate will continue to be higher than 4.19%. So if you're interested, do remember to sign up for it. But also do remember that the closing date will be 1 day before 10 November because 10 November is the auction date. So yeah, if you're interested, you are able to sign up from your iBanking system. Yeah.
What's the tenure again? Sorry, Sean,
the tenure is 6 months. 6 months.
Okay. So okay.
Treasury.
Yeah. So I think even if you get it now 6 months, then 6 months time is you probably he's probably still going to enroll over at probably above 4, I guess. Again, we are just guessing here. Yeah.
Right.
Yeah. Yeah. Okay. Yeah. So thanks, Sean. Yeah. So I think we probably answered most of the questions. Hopefully it was helpful for everyone. If you do have any questions, just go to our P3 Poems 3 app, and there's a community there. Then you can ask us questions, or of course, even better, give us your views. Yeah. So with that, I'd like to thank everyone for your time, and whoever have a good week ahead. And thanks again for your questions and your time. But thank you, everybody. Bye-bye.